Hey, welcome back to The Dive. Today we're chatting with Waseem Shabout from Celsius Network. But before we get into it, I'm just going to remind you to tap that subscribe button, please. Hey, Waseem, welcome to The Dive.
Hey, thanks for having me.
So let's start. Could you walk us through what services Celsius provides?
Yeah, so Celsius offers interest income, so the equivalent of you know, putting your money with a bank and getting yield on it. But instead of it being 0.3%, we pay you 80% of what we earn. So you can earn up to 16% on some coins. But on Bitcoin, for example, today we're paying 6%. On dollars, on stable coins, 10%. And then you can also take loans. So if you want to borrow against your Bitcoin, the same way you can do like a mortgage against your house, borrow against your house, same logic, but just transport it over to, the world of digital assets.
So how does Celsius provide such large returns for depositors?
Yeah, I think the way to think about Celsius is like we're a marketplace, right? There's a supply side and the demand side to every marketplace. In Celsius's case, our supply comes from our users, so retail depositors that are providing us and entrusting us with their assets. The demand side is then generated by lending these funds to institutions in the form of collateralized lending. So we have like an institutional lending desk. Celsius also has DeFi deployments as one of its business legs. We do crypto mining, and then we're always adding in new business lines. But the majority of the Celsius demand generation or yield comes from us lending funds to institutions. It's standard marketplace dynamic, but retail users on one side, hedge funds, large family offices, DeFi, and mining on the other end.
So how do users know their crypto is safe when they make a deposit?
Yeah, no, this is a super important question, right? So, um, I think that one issue with Celsius, right, is that we're not built as a protocol. We're not like a Compound or an Aave where you can see every interaction on chain. There is Celsius is your counterparty. You're sending your assets to a Celsius wallet. They're then being moved into a Celsius custodied wallet, a pooled wallet, from which funds are then lent to and from. We try and do as much as we can to make this transparent to users so they can see what we're saying is what we're reporting in the app or the yields that we're generating are true. But there is counterparty risk. You have to recognize that Celsius is a centralized entity that is lending funds on your behalf. um, we're introducing what we're going to call proof of community, which is ideally a way to make like our books more transparent, a way for people to see that our assets to liability, we have more assets than we have in liabilities, that we are solvent. This is what you need to figure out whenever you're viewing like a financial institution, if they're lending your assets, if you're entrusting them with your value, or even if you're investing in something on a public market, you want to be able to like see into their books. So we're working to release this product called Proof of Community that will give you guys that kind of insight. But today, I think the best way to look at Celsius and understand the risk profile is like see who's on the team, understand maybe like the risk profile of the type of counterparties that we onboard. And then there are a bunch of articles out, like one of which is pretty cool. It was like a case study done by Chainalysis, where they looked on chain and they kind of like stamped that what we say is happening is what's actually happening. But there is no way today to look at Celsius, piece it apart in the same way that you can with something like Compound or with Aave. But we'll get there through proof of community, as I had mentioned.
What kind of risks are present given the overall volatility in crypto to both the borrowers and depositors with Celsius?
Yeah. Something really unique about Celsius, right, is that when users deposit funds with Celsius, the funds or the accounting that Celsius then does. So when someone gives us their asset, we account for that liability back to that user in that asset. So we are a coin denominated entity, right? So anytime we're earning revenues on a user's coin, we're kind of neglecting what's going on in the dollar world, and we're looking exclusively at what is going on in that unique coins world. However, for example, if Celsius is generating its yield in an asset that's like a liquidity mining asset on something like DeFi, and the asset that we're lending into the protocol is Bitcoin, but we're getting paid in comp or something like that. One, immediate risk is that there's kind of like a forex balance that needs to be maintained and managed, but we have some systems in place to hedge that. That's a DeFi risk, and it's at top of mind because it's something that I was looking at previously. But the main risk that I think is just apparent and that people tend to focus on, that I think is uh, one of the larger like risk vectors is when we do lending, it's collateralized lending, but the collateral is a volatile asset. It is Bitcoin or it is Ethereum or it can be any number of digital assets. Or for example, it can be a dollar and then we're lending Bitcoin. So it's the same kind of like delta between the principal and the collateral. And if there's a movement in the market in any one kind of crazy adverse way, if Celsius doesn't liquidate in time, or if the counterparty doesn't in move in more of their assets to cover the margin call, that is immediately like a risk vector. But we have systems and humans that are there to maintain and manage that, as all that the system does and all that the humans are focused on. But again, that's like in the ecosystem at large. Anytime that anyone is doing collateralized lending, you need to either have systems that can liquidate collateral quickly, or you need to be very confident in the collateral, or you need to have a team that's competent that can do the collateral liquidation or reach out to cover the margin calls. And Celsius has these kind of risk mitigation teams and systems in place.
Okay, so let's talk crypto markets in general. The term shitcoin has become a thing on social media. Do you think some of the ironic promotion of coins from the likes of Dave Portnoy backing SafeMoon or Elon mocking Dogecoin on SNL while being long is problematic for the space?
It's the Wild West. It is what it is. Like there's shit coins are gonna pop up all the time. Like there was the Shiba coin that turned like a bunch of people into billionaires overnight. There's like Jake Paul tweeting about MILF token. Like there's it's never gonna end. And like because it's decentralized, this environment is something that you can't just tell them to stop. You can't tell people stop tweeting about something. People will always put their words out unless you start to put in controls. It is the blockchain. Some blockchains can have controls, right? Just like some forms of social media can have controls, like WeChat versus Twitter. If we're doing, WeChat versus Twitter, the Ethereum blockchain is like Twitter. People can just say whatever the hell they want. They might get doxxed. They might get, the coin might get dumped. But this is just the reality of like living in, meme money land. And it's going to be a part of, this ecosystem for, I think, a long time. And it's kind of cool to watch people make a bunch of money off of, Sheeb coin. So we'll see where it goes.
Yeah, for sure. Okay, so is there any opportunity for Celsius to get into the NFT market?
Yeah. It's hard to do lending against NFTs unless you have like an offtake agreement or you have a bunch of bids on the asset. Like with fungible assets like ETH and Bitcoin and all that, you have like a liquid asset that can be liquidated if there is a margin call or whatever. But that said, there's other ways that Celsius could participate in the world of NFTs. Doesn't necessarily have to be with art, right? Like an NFT, a non-fungible token, means something that can be appended to a wallet address or can be provided to a wallet or traded among different wallets that is not fungible. It is one of one, and it is proof that this wallet has possession of that. So if we want to move some of Celsius's infrastructure to be, more on chain, we want to offer different types of services. We've actually been looking at how you can use NFTs as a proof of on-chain, like KYC type approach. But selling digital art and that kind of stuff, I don't think we haven't made any real investments into looking into that, even though it is cool and a lot of the team members are, happy with their Beeples. So.
Okay, so last question here. For our audience watching, how can they sign up with Celsius?
Yeah, super easy. You can go to celsius.network and click download. Right now it is a mobile app, so you'll have to go onto your, Google Play Store or your iOS, what's it called? App Store. And you can download the app there. You sign up, you have to pass through KYC, which means know your customer, just a way for us to say that you are who you actually say you are. So you send like a picture of your face and your ID and all that kind of stuff. And it takes like 3 minutes to get set up. You can transfer assets in and start earning interest right away or taking loans, whichever you need to do. Super quick and easy.
Sounds easy. All right. Well, thank you so much for joining us on the show today, Waseem.
Happy to. Thanks for having me again.
Thanks so much for watching. We'll see you next time. And in the meantime, don't forget to like, subscribe, and share.